Every American recession starts the same way. Not with a stock market crash, not with inflation, not with unemployment, not even with the Federal Reserve raising interest rates. Those things come after the recession has already begun. The true triggers, the real pressure points that break the system, are almost never talked about.
It's crashing! Sell everything!
They don't appear on CNBC.
We're ruined. It's all gone.
They aren't in the headlines.
Get out now!
And by the time the public notices them, it's already too late. Here's the terrifying part. These hidden triggers repeat every 7 to 14 years, almost like a coded pattern inside the US economy. And today, in 2025, those very same triggers are back again. The same signals that appeared before the crash of 1973, before the stagflation crisis of the 80s, before the dot-com collapse, before the 2008 meltdown, before the 2020 shock, they're all flashing red again. Financial analysts see the symptoms: inflation, debt, asset bubbles. But the cause is always buried deeper. Underneath the data, underneath the politics, underneath the surface of an economy that looks stronger than it really is. Today, we're going to strip the system down, layer by layer, and expose the 3 hidden triggers that quietly start every American recession. And then we're going to look at the 4th one, the new one, the one emerging right now, the one that could trigger the next recession faster than anyone expects. Stay to the end, because everything is building toward one question. If every recession has the same pattern, are we already living inside the next one without knowing it? To understand the hidden triggers of recessions, we need to understand one truth about the US economy. It doesn't collapse from the outside. It collapses from within. Think about it. Oil shocks didn't start recessions. They only made them worse. Inflation wasn't the cause. It was a reaction. Fed tightening doesn't cause recessions. It exposes them. Market crashes are symptoms, not origins. The real trigger usually fires years earlier, quietly, without warning. If you go back through history, a strange pattern appears. 1. The US economy always looks strongest right before it breaks. In 1929, the US was booming, right before the Great Depression. In 2007, American homeownership was at record levels, right before the housing collapse. In early 2020, unemployment hit a 50-year low, right before the global shutdown. Strength, then collapse. Boom, then break. Peak, then panic. It's almost ritualistic. 2. The trigger event is always something small, not a big, obvious disaster, but a subtle fracture deep inside the system. Liquidity dries up, consumer confidence drops, credit markets freeze, yield curves invert. Tiny signals. The kind of data only economic historians, Fed insiders, and bond market veterans notice. 3. Once the trigger snaps, the recession becomes unstoppable. GDP doesn't crash in a day. Employment doesn't collapse in an hour. The system simply shifts. Like a fault line in the earth, silent for decades, then suddenly releasing energy stored for years. So what are these hidden triggers? What are the real forces that quietly start recessions before anyone sees them? To answer that, we go back in time, all the way to the recession that changed everything. Every American recession begins with a silent fracture inside the US consumer. Sounds strange, right? Because if you listen to the news, they'll tell you consumers are strong, spending is healthy, Americans are resilient. But here's the truth no politician wants to say. The US consumer doesn't break when they stop spending. They break when they keep spending. on borrowed money. The fracture happens quietly. Credit card debt hits new highs. Delinquency rates creep upward. Wages stagnate while costs rise. Personal savings drop. People spend more than they earn. Debt fills the gap. Credit markets tighten. Households fall off the cliff. This exact chain reaction triggered
with inflation reaching new highs
the 1973 recession, when inflation outpaced wages and consumer credit dried up.
I don't know how we're going to pay these bills.
The 1980 recession, when household debt hit historical highs and interest rates exploded.
We have to issue the
The
foreclosure
2001
notices today.
recession, when consumer overconfidence met collapsing tech wealth. The 2008 recession, when people bought homes they couldn't afford on loans bankers shouldn't have issued. And now, the numbers in 2024 to 2025 look disturbingly familiar. Credit card debt, all-time high. Savings rate, all-time low. Mortgage stress, rising. Delinquencies, surging. Wage growth, slowing. Living costs, exploding. The same fingerprints, the same cracks, the same quiet pressure building beneath the surface. But consumer fractures are only the first trigger. The second one is far more dangerous, far less visible, and far more systemic. It's the trigger that Wall Street fears more than anything else. Because once it snaps, the recession becomes unstoppable. And in 2025, this trigger is already bending. If the consumer crack is the first fracture, then the credit freeze is the earthquake. This is the trigger almost nobody sees coming, except bond traders, commercial bankers, and the Federal Reserve. And even they get blindsided. Here's the brutal truth. The U.S. economy runs on credit, not cash. When banks stop lending, even just a little, the entire system starts suffocating. It doesn't matter if unemployment is low, the stock market is high, GDP is growing, politicians say the economy is strong. If credit tightens, recession is already inside the walls. What does a credit freeze look like? It's subtle. You won't hear about it on the news. It looks like this. Banks quietly raise lending standards. Small businesses can't get loans. Consumers get denied credit increases. Auto loan approvals fall. Mortgage applications collapse. Corporate loans shrink. Delinquencies rise. Interbank lending slows. Treasury markets become unstable. This happened in 1973. OPEC shock plus credit tightening. Deep recession. 1990. Savings and loan crisis. Banks froze lending. 2008. The mother of all credit freezes. 2020. Repo market broke before the pandemic hit every time. The same pattern. But here's the part that should worry you. 2024 to 2025 shows the exact same signals. Banks tightening lending for 11 consecutive months, small business loan approvals near 10-year lows, auto loan rejections at record levels, mortgage lenders turning away even high-income applicants, treasury market liquidity drying up. This is the equivalent of blood flow stopping in a human body. The heart is still beating, but the organs are dying. Why does the credit freeze happen? Because banks sense danger before everyone else. They feel tremors deep in the system, long before the public notices. And right now, U.S. banks are acting like a storm is coming. A big one. But we're not done. Because the third trigger is the one that transforms a recession from bad to historic. And it's the one repeating right now with terrifying accuracy. There's something economists don't like to admit. Recessions are psychological before they're financial. Consumers spend based on belief. Investors buy based on belief. Banks lend based on belief. Companies hire based on belief. The moment belief cracks, the economy follows. You can see this in every recession. 1970s. Americans lost faith that inflation would come down. They stopped spending. Recession deepened. 2000 to 2001, tech investors lost faith in dot-com companies. NASDAQ crashed 70%. 2008 homeowners lost faith that prices could go up forever. Housing froze, collapse. 2020 virus ended confidence in mobility and consumption overnight. Confidence, not credit, not GDP, is the invisible foundation everything stands on. And right now, American confidence is collapsing on all fronts. Consumer sentiment, still stuck near recession levels despite low unemployment. Small business outlook, lowest since the financial crisis. Investor confidence, volatile, inconsistent, dependent on Fed signals. Government trust, near historic lows. Institutional trust, banks, corporations, even the Fed, all declining. When a nation stops believing, a recession is already growing underground. Why does confidence matter so much? Because confidence influences decisions. When consumers lose confidence, they stop buying. When businesses lose confidence, they stop hiring. When investors lose confidence, they stop investing. When banks lose confidence, they stop lending. When the government loses confidence, they panic print.
Likewise.
A recession is ultimately a chain reaction of fear. The consumer crack weakens the system. The credit freeze destabilizes it. The confidence break collapses it. And history shows, once all three triggers fire, nothing can stop what comes next. But here's where things get even more unsettling. In 2024 to 2025, we're seeing a fourth trigger, one that never existed before. A new force in the economy, one that could make the next recession faster, deeper, and more unpredictable than anything in modern American history. For the first time in American history, recessions might not be triggered by consumers, banks, or even confidence. There's a new player in the system, a new force, a new vulnerability, the fragility of the modern digital economy. Never before has supply chains been this global logistics, been this thin inventory levels, been this low. Businesses relied so heavily on real-time systems. Markets been this algorithmic money. Move this fast? Panic spread instantly through social media. Bank runs happened online in minutes. In 2023, Silicon Valley Bank collapsed in 36 hours, not because it was weak, but because digital panic spreads like wildfire. This is the new trigger, a digital chain reaction that accelerates every shock. A rumor becomes a tweet becomes a trend becomes fear becomes a bank run, and a bank run becomes a recession. This never existed before 2010. It barely existed before 2020. But now, every economic tremor moves at light speed, and in a system built on confidence and increasingly built on code. That's the most dangerous risk of all. Every recession in American history has shared the same three triggers. 1. The consumer crack. 2. The credit freeze. 3. The confidence break. They appear in different shapes, different orders, different intensities, but they always appear. Think of them like fault lines under the U.S. economy. Sometimes they move slowly, sometimes violently, but they always move. And now, for the first time, we have a fourth fault line. 4. Digital acceleration. A recession can now spread faster than the Fed can respond, faster than Congress can act, faster than banks can stabilize, faster than economists can measure. This is the most dangerous economic structure the world has ever built. More interconnected, more leverage, more digital, more fragile, more psychological, more algorithm-driven. And history tells us something chilling. When multiple triggers overlap, recessions become systemic. Examples: 1973. Consumer crack plus credit freeze plus oil shock 2001. Confidence break plus market overvaluation. 2008. Consumer crack plus housing credit freeze plus confidence collapse. 2020. Confidence break plus digital panic plus supply chain failure. Each layer makes the next one inevitable. Recessions aren't random. They're not bad luck. They are the result of patterns so old, so deeply rooted, that the U.S. economy unknowingly repeats them every cycle. And right now, those patterns are forming again. The same signals, the same weaknesses, the same tremors. The question isn't, will there be another recession? There is another recession forming. The real question is, how close are we to it? Let's lay the data out clearly. Not the fear, not the headlines, just the facts. 1. Consumer crack credit card delinquencies rising, savings rate near historic lows, personal loan growth exploding, rent, plus food plus energy costs, outpacing wage growth. This mirrors 2007, 1990, and 1974. 2. Credit freeze banks, tightening lending standards for a full year. Treasury market showing fragility. Commercial real estate defaults rising, auto loan approvals plunging. This mirrors 2008 and 2020 September repo crisis. 3. Confidence break, consumer sentiment at recession levels. CEOs expecting a downturn, investors swinging wildly on Fed announcements, institutional trust declining across the board. This mirrors 2001 and late 2007. 4. Digital acceleration bank runs happen in hours, SVB. Social media amplifies economic fear, algorithmic trading magnifies volatility, real-time data makes panic faster. This has no historical parallel. It's new and it's dangerous. When you line these four together, a disturbing picture forms. America is not heading toward the next recession. The structural conditions of a recession are already here. The only thing missing is the spark. A small event, a sudden shock, a headline nobody predicts. Historically, a spike in oil, a geopolitical conflict, a liquidity failure, a corporate bankruptcy, a banking issue, a policy mistake. Anything could be the ignition point. The deeper question is, what will the next recession look like? Here's the truth. The next U.S. recession will not look like 2001, not like 2008, not like 2020. It will be a hybrid recession, a combination of multiple eras. The inflation of the 1970s, energy shocks, plus elevated prices, plus sticky inflation. The credit stress of 2008 banks tightening earlier than the public expects, the psychological break of 2001. Fear returning to markets quickly and violently. The digital panic of 2023, SVB, runs in contagion spreading online within hours, and unlike past recessions, this one will be driven by high interest rates, demographic decline, political division, supply chain, fragility, global de-dollarization, AI, and automation weakened global alliances. It won't be a single shock. It will be an intersection of structural weaknesses. A recession created by tired consumers, cautious banks, nervous investors, digital panic, geopolitical instability, government overextension. Think of it like a storm formed by multiple weather systems merging into one. And when all the winds meet, you get a superstorm. But that's not the final twist. There is one last question, the one this entire investigation has been building toward. Economists tell you recessions are declared after they happen. Data tells you recessions are measured after the damage is done. Politicians tell you everything is fine until it's not. But history tells a different story. Recessions begin long before they're officially announced, long before people feel them, long before markets crash. They begin in the cracks, in the freezes, in the loss of belief, in the whispers of digital panic. If you look at the data objectively, without politics, without emotion, without denial, the pattern is already here. The triggers are already firing. The system is already shifting. We are not waiting for the next recession. We are walking through the opening chapter of it. Quietly, slowly, unnoticed by most, but visible to those who know where to look. And that is the story few dare to say out loud. Not because it's certain, but because the pattern has never been wrong. This is the Finance Detective. And you've just seen the hidden triggers of every American recession, including the one forming right now.